Yo, what's going on, everyone? Today, in this episode of Understanding ICT Concepts, we're going to go over liquidity. What liquidity is, how to spot liquidity, and how to understand where market is going using liquidity. Now, before we get started, I just want to mention that liquidity rests below old lows and above old highs. And what does that mean? So if you look at a candlestick, we know that there's a body, right? The open and the close of a body, right? The open is where price opened at, and the close is where price closed at, and we have the wick. And this wick is where price has traded to, but is not where price closed or opened at. So, below old lows is sell side liquidity, and above old highs is buy side liquidity. And you may be wondering, why is this called buy side liquidity and why is this called sell side liquidity? When we're buying the market, we want price to go up, and we're selling the market, we want price to go down. So why is this sell side liquidity? Why is this buy side liquidity? Well, liquidity is buy stops and sell stops. So when you are going short in the market, right, and you have your stop loss above a high like this, targeting a lower low like this, in order to get out of your sell position, you need to buy the market. So that is why this is called buy side liquidity, because liquidity are stop losses, buy stop losses and sell stop losses, right? Or short, people who are going short and people who are going long, the stops for those people. And we're able to see that if we did go short here, right, and this candle came to our stop loss, we would have to buy the market in order to get us out of this position. And the same goes for sell side liquidity. If we were to go long right here and the market stopped us out right here, it is because we bought the market, and in order to get rid of our buy positions, we need to sell the market, which is why these are named like this. And you may be asking, now, what do you mean by liquidity rests below old lows and above old highs? Well, once again, coming back into this candlestick, we have the wick, the bottom and the top of the wick. Each of these candles, each of these wicks, I guess, parts of the wick, both have liquidity. The top part of this wick will have buy side liquidity, and the bottom part of this wick will have sell side liquidity. And that is the same case with every single wick or candle that is created. There will always be buy side liquidity above here, there will always be buy side liquidity above here, and there will always be sell side liquidity below here. And now we'll go over eventually how to tell which low holds more significant value, meaning there is more liquidity there than others. But before we move on to that, I'm going to assume we understand what buy side liquidity is, sell side liquidity is, and how to spot them. They're on the top and bottom of wicks. Now, before I go any further, I want to emphasize that there are only two things that the market does. The market seeks out liquidity or takes liquidity, right? Or they rebalance imbalances, which this is also a form of sweeping liquidity. That is also a form of seeking liquidity. So if we come into a live chart right here, let's take a look at what I mean by that. So an imbalance is basically a fair value gap. And what did I say about old highs and old lows? There are liquidity resting above and below them, right? So there is liquidity right here, and this is called internal liquidity. This is called internal liquidity, and swing highs like this are called external liquidity. So that is external and internal liquidity said very simply. Anyways, coming on how to properly spot liquidity. Well, let's take a look. Let's go to a good example right down here. As we can see, there's liquidity above all of these highs. There's liquidity above all these highs. Why is there liquidity above this high? And why is there liquidity above this high? Well, because we traded above this high, right? So that means there's liquidity here, and we traded to above this high, so there's liquidity here. But why is there still liquidity here when this candle wick is higher? Well, because nothing further down the road has traded above this wick. In order to take liquidity from something, or from a candle, or to sweep liquidity, you must see another candle like this trade higher than these candles right here, or this wick right here. And that is pretty much it. You just want to see it trade higher. It can be by 1 tick, it could be by just a smidge, right? This is by 1 cent. But with this 1 cent, we were able to take out every single person who had their stop losses above this high, just by that 1 cent. Or even if they put it 1 cent higher. So we took out these stop losses. Now, you may be asking, well, this double top, what does this mean in terms of liquidity? Well, this double top means that there is even more liquidity above here because these are equal highs. So there's going to be even more stop losses here. If this candle never happened, there would have been stop losses above here. And then we see this candle come up and trade not above it, but to the same exact price of it. And that is called equal highs. And that is where there is even more liquidity than just one candle trading high. As we can see, we have another double top right here. And the next point I'm going to go over to is called relative equal highs. Relative equal highs are highs or are liquidity points that are relatively equal. So what do I mean by relatively equal? Well, I mean they are relatively close without being taken. Like this is pretty relatively close to this. So these two highs are relatively equal. And this high is pretty close to this high right here, making this a relative equal high. And what are relative equal highs? Well, relative equal highs are basically where there's liquidity still resting above these highs, but they're relatively equal. What does that mean? It means they are close together, and it means that there is a lot of liquidity resting in this area right here. In this area right here, there's a lot of liquidity that the market wants to come back to. So let's go down to here, and then we see this liquidity right here. All right, this is sell side liquidity because it is below old lows, right? There's liquidity here, liquidity here, liquidity here, and liquidity here. Before they were traded through, right? We can see it was traded through by a wick. Traded through by a wick. So that means these no longer have liquidity underneath them. They no longer have liquidity underneath them. And there is now going to be liquidity here because they have been swept by this candle right here. Now this candle has liquidity and this candle has liquidity, and so price comes down here, right? And you can also consider these two candles right here, or these two candles right here, relative equal lows as well, which means there is more liquidity here that wants to be taken. And we can see even down here, this is a great example of relative equal lows, right? We can see this one, this liquidity hasn't been taken yet because this candle hasn't traded below it. So leaving these two candles, you see how close they are? Relatively equal. Same goes for right here as well, right? These are relatively equal. And same goes right here as well. These are relatively equal. So these make great take profit points and great targets for price when price wants to go and seek out liquidity. And I'm going to take us to a higher time frame right here. And this makes the liquidity even easier to spot and just how much there is everywhere. So we can see how smooth this high looks, right? It is pretty much almost a straight line, right? We can see it's almost a straight line with liquidity that has still not been taken in the terms of relative equal highs right here and right here. Well, I guess this was taken, but right here, right? We can see that there are highs right here, and we can see that there are highs right here, right? Making these relative equals, and we can go even higher to right here. And we can see that these are all relatively equal. Look how close they are to each other. 7 cents away, $1 away, and $2.50 away. So they are super close. And we can see how smooth this is, right? there's not a whole bunch of bumps like this. Now this is rigid, right? This is rigid, bump, 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 bump. But there's still a lot of liquidity resting below these relative equal lows, right? But so why was price going to take these highs before coming down and taking these lows? We can see the smoothness of them. The smoothness of them is what makes price more likely to draw to this before drawing to this, right? You see how rigid it is compared to look how smooth this is. So we can see we came and we ran above these highs, taking out all this liquidity, and then we made equal highs right here. And you can see eventually these equal highs were taken right here. Anyways, I hope this explains liquidity really well to you guys. I hope you guys understand liquidity, how to spot them, what liquidity is, and I hope you guys understand what relative equal lows are, relative equal highs are, and everything you need to know about liquidity. And as always, I'll see you guys in the next episode.